Okay. So did what we have finished, like what is like supposed to be finished now? Did we do this inventory turnover days? Please tell me. In the previous class. Hello.
So we did till payable.
Payable turnover ratio, correct?
Yes, sir.
Hello. Yeah, yeah, okay, okay. Yeah. So now, like we'll see the textbook version of the formula. See, I told you how to find out the like debt collection period, isn't it so? So my formula for debt collection period was debt. Okay, like we will see stock conversion period. So the formula which I gave you was 365 days divided by stock turnover ratio, correct? Now let us do this like how did you get this formula? It's nothing but so 365 divided by what is the formula for stock turnover ratio? COGS by inventories or average stock. Isn't it so? Please tell me if it is current year, it is inventory. Am I right? No average. If you have 2 years data, you have to find out average. If you don't have 2 years data, you need not find out average. Everyone can see the screen or not?
Yes, sir.
Can you see the screen? Everything is clear? Okay. So what did I say? If you have 2 years data, if you have 2 years data, just a second. Yeah, just can just hold for a second, 2 minutes. Yeah. So if you have like 2 years data, like say this is 2022 and you have 2021's data. If you have inventory of both the years, then you'll go for average inventory or average stock. But if you have only 2022's data, you can't go for average stock, correct? And I think this is 20 like you can't go for average stock. So you have to just take the inventory of 2022. So now see little maths. If this goes up, if this is if you have a fraction in the denominator, so like a whole divided by b by c, so this c would go up. So a into c by b. So in the same way, when you have fraction in the denominator, so inventory would go up. So it will become, so I'm just writing it here, 365 into inventory by COGS. Okay, so please make a note of this. Hello, are you writing?
Yes, sir.
Hamsika, are you writing?
Yes, sir, I am.
Okay, okay, okay. Who you also please make a note of this.
Done, sir.
Yeah. In the same way, the next one. So if it is receivables collection period, so like we will like what formula did I give you regarding this debt collection period? The formula for debt collection period is 365 days in a year divided by debtors or receivables turnover ratio. Okay, so now 365 divided by, what's the formula for receivable turnover ratio? Net credit sales. Okay, or I can write revenue. See, one thing you should understand, we don't differentiate between credit revenue and cash revenue. Whatever revenue comes, so how do you account cash revenue and credit revenue? Suppose I did a sale of $100,000 on cash basis. So I write revenue in the income statement of $100,000, correct? And in cash account, I write $100,000 in the balance sheet. Let's say I did a sale of $150,000 on credit basis. So I will write the revenue of $150,000 as usual. So my entire revenue is $250,000. But I will write this, whatever the credit sales I did, I'll write receivables in the balance sheet. Correct or wrong? Because this
Correct, sir.
credit sale is nothing but receivables for me. Okay, so in the same way, in the balance sheet also, the $250,000 you will add up. I can understand who these are all new things for you, but I expect you're understanding this. Correct? Hello. Hello, Hoor, are you there? Hello.
Yes, sir. Yes, sir.
Yeah, did you understand this concept?
Yeah, sir. Yes, I'm understanding it.
Yeah, yeah. So that is what it was. And now like 365 by data's turnover ratio, receivables turnover ratio. So the formula is like 365 by the formula for receivable turnover ratio is revenue by like trade receivables. If you have just only 1 year's data, if you have 2 years data, you'll do average. So again, the fraction is in the denominator. So the trade receivables will go up, and 365 by 365 into trade receivables by revenue. Okay, please make a note of this. If done, inform me, I'll go next.
Yes, sir. Done.
Who confirm me, have you finished? I'll move forward. Hello.
Yes, sir. Done.
Okay, okay. Next comes the, and you should be one more thing you should be understanding. You should read the text completely before the test. Read each and every point of the text. Okay, and I'll give you some good testing questions from some other sources even, and I'll see how you're going to answer those questions even. Okay, now payables payment period. So debt payment period, the formula which I gave you was uh, like uh, like 365 days in a year divided by creditors turnover ratio or payables turnover ratio. So the formula is 365 by uh, credit purchases, or I can say cost of sales. That means if you don't have opening inventory or closing inventory, okay, then whatever the purchases you have done is equivalent to cost of sales, correct? So or cost of sales whole divided by trade payables. Okay, if you don't have 2 years figures only, you can take single year figure. So that's what I'm saying. When you will be seeing your income statement, you will not be finding purchases separately anywhere. You will be only given cost of sales. Okay, So in that case, when you will not be given any kind of data related to purchases, and you'll be given cost of sales, then you can just assume cost of sales as your purchases. Okay, is this point clear for you? Because they're going to solve a question right now. Please tell me. Hello.
Yes,
Is
sir.
my did you understand? Yeah. So this goes up, then it becomes 365 into trade payables by cost of sales. Come on, note this down.
Yes, sir.
Now, what is this working capital cycle? So working capital cycle is nothing but, see, what is working capital? Working capital is nothing but current assets minus current liabilities. Okay. So like I have already explained you about working capital. Did I explain you about working capital? Please tell me. Okay, we will just do one thing. This is not that relevant even right now. We will first focus on ratios. We'll wind up all the ratios, then we'll get back to this. Don't worry. Yeah, the next ratio happens to be asset turnover ratio. Okay, so generally when I speak about the word turnover, what comes into your mind? Revenue, correct? So revenue is nothing but sales. So revenue whole divided by like capital employed. I will say capital employed is nothing but total of assets minus current liabilities. So this is your balance sheet when you have this total of assets, and from that this is like total of liabilities plus equity. From total of assets, if you remove current liability, you are left over with equity and what? Long term debt. Am I right? So these two when combined together, okay, is nothing but what? Is nothing but capital employed, which I have already explained you in the previous class. Okay, so if from total of assets I remove this portion, I am left over with this portion. So that is nothing but capital employed. I don't know what is the logic behind this ACCA board to take capital employed here. You see anywhere in Google or any other books or any other course, if you study, they simply give revenue or sales by total assets. That makes sense. Okay, but these people are saying revenue by capital employed, but I'll explain you what does it mean. Okay, so with this ratio, even you are checking some efficiency. What is the efficiency? I'll tell you. Suppose there is a 1000 SFT shop. Okay, and there is a 10,000 SFT shop. So 1000 SFT shop and 10,000 SFT shop, both, okay, both the shops sell garments. They are into ready-made garments. So this particular shop, the entire valuation of this shop, that means the furniture, the building, the land, the entire value of this shop happens to be let's say 10 lakhs. Okay, 10 lakhs is better understood by Indian students. Instead of 1 million, I won't use that term as 1 million. Instead of that, I'm using 10 lakhs. And this particular 10,000 SFT shop, which is 10 times of this, of course, the investment which we have made is 50 lakhs. That can be 5 million, but I'm saying 50 lakhs. Okay, you are more habituated to this. Now, the revenue generated here is how much? Is, let's say, 1 crore, and the revenue generated here is also 1 crore. Now we will see the efficiency with which we have used our assets to generate our revenues. So what is that we will see? So like how much is the revenue what we have got? This is the revenue. This is the total assets value. Okay, in both the cases. So we will take revenue in the numerator divided by total assets 10 lakhs. Here also we'll take 1 crore by 50 lakhs. Okay. So here we have invested $1 and we have generated a revenue of how much? $10. Please tell me yes or no. Yes or
Yes, sir.
no. And here we have invested $1 and we have generated a revenue of how much? $2. Correct? Correct or wrong?
Yes, sir, correct.
So what do you think? Which is a better performing shop? This shop is a better performing shop. Why? Because they have done the most efficient utilization of their asset. With a given investment of just $1, they have made $10 of revenue. Here with a given investment of $1, they have just generated, I'm saying just $2 of revenue. So here clearly we can say that here there is no efficient utilization of assets in this particular case. Okay, that means this business has to do some like lot of they have to put lot of efforts to generate very high revenue so that their asset turnover ratio can be high. Here the asset turnover ratio is 10 times. Here the asset turnover ratio is just 2 times. Okay. So with this, we understood the concept very properly, but ACCA people have a different notion. They, instead of using total assets, are taking capital employed into picture. So I can also tell you one thing. If there is no current liability, can I say total assets is equal to capital employed? Please tell me yes or no. If there is no current liability, please understand what I'm saying. If there is no current liability, total of assets is equal to capital employed or not? Please tell me.
Yes, sir.
Yes, of course. If there's no current liability, then equity plus long-term liabilities or long-term debt. Okay, when we add up, that will be very much equal to total of assets because there's no current liability. Since there's current liability, we are removing current liability from total assets. Now we are just removing this from this and we are getting the difference amount. So, but if this is not there, there's no difference. Now, the concept is very simple and very clear. We have invested. So let's say that shops example, we have invested 10 lakhs here and we have invested 1 lakh here and we have generated a revenue of 10 lakhs. Okay. Or let's say we have invested 10 lakhs. We have generated a revenue of 1 crore. We have invested 50 lakhs. We have generated a revenue of 1 crore. Okay. The investment here is nothing but capital employed. So for $1 investment in assets or $1 of investment in whatever thing it is in the business, we have got $10 of revenue. $1 has given me $10. Here $1 has given me $2. So this is always better. Okay. So go with the ACCA's notion. Don't get confused. I have just given you the differences and tried to explain you the concept in an easy manner. Now we should understand some links. The links are very simple. You can find out ROCE in this way even. How? See, first of all, to do a business, what is this TALCL? Oh, this is what. Okay. See, to do a business, you want what? Please tell me. Come on, tell me. You want what?
Capital.
Capital. So that capital has to be employed. Am I right? So now what you're doing is you are employing the capital in the business. What do you mean by capital employing or capital employed? You are investing the money in the business and that investment can be to buy assets for the business or for any other purpose, relevant purpose for the business. Okay. So you invested some 10 lakhs. Okay. When you invest money, that means you have set up your business. And what do you expect now the business? What do you expect now in the business? You want to generate what? Revenue, correct?
Profit. Yes, sir.
You invested your money in the business and you have completely set up your business. Why you set up your business? You set up your business to generate what? Revenues. And why are you generating revenues? To earn what? Correct? Yes or no?
Yes, sir.
You invested. You invested 10 lakhs, okay, to generate revenues. You are generating revenues to ultimately earn profits. Okay, so if I kind of club some ratios here, will I get return on capital employed? Let's see. First of all, when you invest your capital to generate revenue, can I say that is equivalent to asset turnover ratio? Please tell me yes or no. You have invested your capital to generate revenue. So did we, like in this case, what are we seeing? For $1 of investment, how many dollars of revenue I am generating? Am I seeing this or not? Please tell.
Yes, sir.
Yeah, for $1 of investment, or for $1 of capital which I am employing in the business, how much revenue I am generating? We calculated as $10, correct? So I am taking which ratio here? Asset turnover ratio. This is nothing but asset turnover. Point number 2. Now, so I'll come to the example. See, I invested $1 and I got $10 of revenue. Now my profit happens to be, my profit happens to be, let's say, just a second, I'll put some imaginary figures here. So revenue is how much? $10. Revenue is how much? $10. Okay, and the capital employed is $1. Again here the revenue will be $10 because this should cancel, and my PBIT by capital employed, let's say the revenue which I got $10, I made a profit of let's say $2. Okay, so I invested $1, okay, in the business and I got a revenue of $10. From $10 revenue I got 20% margin. 20% margin. Okay, so 20% margin of this would be $2. Am I right? 20% margin. Come on, tell me please. Are you following what I'm saying? Hello?
Yes, sir.
Okay. So now, very simply, again, I'll explain. I invested $1 of capital and I generated $10 of revenue. These are all imaginary figures. And from that revenue, I'm expecting 20% margin or 20% profits. Okay, I'm estimating. So those profits happens to be $2. So I'll put that in this slot. Okay, so I cancel this. $2 by $1 is $2. Okay, okay. Let's say dollar cancel. If I want to find out this as percentage, I can find out in percentage form even. So 2 by 1 into 100 would be somewhere around some two. Okay, let's keep it like LHS is equal to RHS, not in percentage form, because we are not finding out any ratio here. We can, yeah, we are finding out return on capital employed. Okay, 200%. Let's say, like if we take like 100 here. Okay, if I take right hand side RHS, what is my PBIT? $2. Correct or wrong? Please tell me. And what is my capital employed? 10. And if I take 100 here, then what will I get? I'm getting 20%. How come I can get 200 here then? Revenue. Okay, the capital employed was how much? $1. Okay, here also it was $1. Fine, 200%. Okay, so LHS is equal to RHS or not? Come on, tell me.
Yes, sir.
Yeah,
Yes, sir.
so $2 I took PBIT and $10 I took revenue. This was my profit margin, which was 20%. Okay, and revenue by capital employed, the revenue which I generated, that means I invested $1 of capital and I generated $10 of revenue. So 20% into 10 is 200%. Okay, and when I see the RHS, PBIT is what? $2 and capital employed is $1 into 100. So it is not cancelled. Sorry, it is 200%. Okay, so we can find it in this way even. Next formula. We are just having two more ratios, that is interest coverage ratio and gearing. So please understand. Now, What is this interest coverage ratio? See, suppose you are a bond holder in a company, or let's say you are a creditor to the company. You have given loan to the company. Okay, no space left or anywhere. Okay, you have given loan to the company, loan to XYZ company. Now, what do you want from that company? Of course, when you give loan to someone, you want interest. Am I right? Someone who gives loan to some XYZ. Okay, so here in the case, ABC has given a loan to XYZ company. So ABC is nothing but the creditor of the of XYZ company. Creditor. Why he is creditor? Because he has given loan to company. Okay, because like XYZ has an obligation towards ABC. They have to repay the money back to ABC. So that's the reason why we can say ABC is creditor to XYZ. Now, what after giving loan to XYZ, definitely ABC would have taken some assets and given loan to XYZ, some securities he has pledged and given the loan to XYZ. What would ABC be worried about? He is a creditor to XYZ. He is not an investor in XYZ company. So he is not looking for profits. Someone who is a creator only looks for his share of income from that company, which is not, or his kind of income from that company, which is nothing but interest. Okay. So many people who give loan to someone wants interest. Okay. They don't want to take that much of risk. They want to take very less risk. So when you see interest amounts are very less when compared to the profits. What shareholders make out of a company, because ABC has very less risk in XYZ company, because ABC has already taken assets of XYZ company, documents of XYZ company, and given loan to them. Now, ABC now wants to check XYZ capacity to repay the interest to ABC. So what is the way he can check the capacity of XYZ company to repay the interest to him? With the help of interest coverage ratio. So this ratio will give confidence to ABC about XYZ companies interest paying capabilities or interest paying capacity. So what's the formula for interest coverage ratio? PBIT by fixed interest charges. Now, why I am taking PBIT, why I am not taking PAT? Because it is the operating income. PBIT is also called as operating income. It is the operating income out of which the interest has to be paid to the creditors or to the liability holders. Okay, it is the operating income from which interest has to be paid. So when I remove interest from PBIT, the next thing which I get is PBT. Okay, so then I remove taxes, then PAT, then this would be the one which has to be shared amongst the shareholders. What like you have to give to the creditors is interest. Okay, so for paying them, like we cannot pay them interest from this profits. Of course, we have to pay them interest from this profit. So we take PBIT. So let's say the PBIT is $100,000 and the fixed interest charges what ABC want from XYZ company is $10,000. Okay. Okay. So let's say they have to pay every year XYZ has to pay 10,000 to ABC as interest, and let's say this current year's profit what XYZ has made is $100,000. So what is the capacity of XYZ to pay to ABC? Can I say that is 10 times? Please tell me. 10
Yes,
times or
sir.
not? Yes. So that is good, na? 8 to 10 is ideal. That means that much capacity. If a company has to repay the interest, then you need not worry about investing or giving loan to such kind of companies. Come on, make a note of all this. I'm just going to wind up this by taking one more ratio.
Yes, sir. Done, sir.
Okay. Yeah. Okay. Who have you finished this? I'm just giving you 2 minutes of time. Just make a note of this.
Yes, sir.
Okay. If it's
I
done, then
got
I'll
it.
move forward. Yeah. However, need not worry. The recordings are there. Recording is like already happening here. Now, last ratio, gearing. So what is this gearing ratio all about? Gearing has to do with non-current liabilities. Okay. So it is nothing but we are seeing the proportion of debt finance in the total capital. So let's say the total capital of the company in form of equity, let's say equity is $100,000 and see, this is a balance sheet. Okay. This balance sheet has equity, long-term debt. Long-term debt is also called as non-current liabilities and current liabilities. Okay, so we get a total, and this is like liabilities side of balance sheet. This is asset side of balance sheet, and here we have like current assets and fixed assets, and then comes the total assets. Okay, now total liabilities. Now let's say I just like this is not something which I take as long-term capital, so I remove this. So my long-term capital is in the form of equity, which is 100,000, and in form of long-term debt, which is, let's say, like again $100,000. Okay. So now my non-current liability is 100,000. So how much is my non-current liability in total capital? Can I say 50%? Yes, I can say 50%. I have 50% debt in my company and I have 50% equity in my company. Can I say this? Can I give this statement? Yes.
Yes, sir.
So many companies want to take more debts than equity. Why? Because they find it more easier to like arrange, and they have some advantages with this debt finance. What advantage they have is debt finance companies have to pay interest. Debt finance is nothing but loan. When companies take loan, they have to pay interest. Okay. To whom? To the liability holders. Okay, that means to the creditors, let's say creditors or bank from whom company has borrowed. So when company, like, that is called finance cost for the company. So if you this finance cost can be taken as deduction or claimed as deduction. That means this finance cost can reduce the taxes for company. How? So let's say like company has to pay tax of like I'm not giving you all details, not required. Company has to pay tax of 100,000. So this $10,000 what they have to pay as interest, they can deduct from this taxable income because that is deduction for them. Okay, deduction is nothing but it is some expenditure which you can use to reduce your taxable income. So like 30% is the tax rate. Previously company was supposed to pay 30,000 as tax. Okay, now since they have this interest as deduction, it's not necessary now that company will always have debt finance. Let's say we are taking two companies here, one company with debt finance, one company without debt finance. Let's say company, let's say situation number one is company do not have debt finance, it only has like equity. So it's profit, it's taxable income, not profit, it's taxable income. See, there's a difference between profit and taxable income. You should understand how profits are nothing but this is the figure which you get after making the financial statements, and taxable income is nothing but the income which you get when you file tax returns. Okay, these two are different things. A person who like has a company has to prepare his financial statements as well as to pay taxes to government. He has to file tax returns to government. That means to income tax authorities. He has to make tax returns also. Okay. So these two work on different concepts, different rules. So let's say like the company, like scenario number one, that company is all equity company. There's no debt. So of course the profit is 1 lakh and the taxes has to be paid as how much? 30% of this. That is 30,000. But let's say this is scenario number one. Scenario number two is company do not have company has debt as well as equity. This is debt and equity combined company. This is just equity company. Okay. So when we have debt, we have to pay interest, and that interest we can use to claim deduction. Okay, deduction. We can claim deduction. That means we can remove that interest from the taxable income to get to get to reduce our taxable profit. So our taxable profit now is 90,000 because we have deducted, we have taken this 10,000 as deduction. Why are we taking this 10,000 as deduction? That income tax authorities are giving you benefits to taxpayers, that some expenses you can reduce from your taxable income. We are allowing you to do that. We are giving that benefit to you. Correct? We always look for some benefits from government now. So for genuine taxpayers, government gives some benefits. Now 90,000 we got. Now from our this 90,000 into 30% is how much? 27,000. Correct? Now here the tax is 30, here is the 27. So we saved how much? 3,000. This is what? Cash savings. Am I right or wrong?
Right, sir.
That's the reason why many companies they opt for debt finance, because they save a lot of money in this way. Okay, make a note of all these points and we are done with that ratio. I will
Sir,
give you a small idea. Yeah.
sir, would this 3,000 be the taxable income?
No, this is savings, cash savings due to paying less taxes. We paid 3,000 less taxes, na? So
Yes.
that much less cash has gone out of our cash account. That much we saved, isn't it so?
Yes, sir.
Yeah, here we paid 3,000 more from cash account. Here we saved 3,000 from in the cash account because we paid just 27,000. So we have 3,000 left over in our cash account, correct?
Yes, sir. So whatever we save would be different from the taxable income?
Oh, like now this chapter is closed. This is in your balance sheet. You're saving. That's it.
So what is the difference, sir, of taxable income and savings?
There's a difference, na? Taxable income is the income which you get when you file income tax returns. Savings is your cash savings, your amount in your cash account. At the end of the day, physically you have to pay cash for tax for like your taxes, na?
Yes, sir.
Whatever you do in the books is okay, but at the end of the day, when you go and pay tax to the authorities, you have to pay cash amount or you have to give a check. So this much will be like this much will be surplus in your cash account because you are paying this much only instead of this much. Correct?
Okay. Yes, sir.
Yeah. Once write everything. Excuse me. Hello.
Yes, sir.
Yeah. So this is done. I actually was about to finish this, but some problem happened yesterday. I gave some. I'm just calling 2 minutes.